Let's face it, ETFs are everywhere. They're marketed as the perfect investment for beginners, touted by financial influencers, recommended by advisors, and praised in every how to start investing video on YouTube. But here's the truth. Not everything about ETFs is sunshine and compound interest. In fact, there's a dark side to ETFs that nobody really talks about. And if you're serious about building long-term wealth, you need to know about it. Today, I'm going to break it all down. The risks, the hidden mechanics, the blind spots, and why blindly throwing your money into ETFs might be more dangerous than you think. So buckle up, because this might change the way you look at passive investing forever. Let's start with the basics. What makes ETFs so attractive in the first place? They're low cost, diversified, and easy to buy. For example, instead of picking individual stocks, you can buy an ETF like the S&P 500 and own tiny pieces of the 500 largest companies in the US. Simple, right? But here's where it gets tricky. 1. ETF structure isn't as simple as it looks. Most people think they're buying actual stocks through an ETF, but that's not entirely true. When you buy an ETF, you're actually buying shares of a fund that tracks an index. The ETF provider uses your money to create a basket of underlying assets. But depending on the ETF type, they may not even own all those stocks. Synthetic ETFs use derivatives to mirror performance. That means if something breaks in the financial system, your ETF might not be as safe as it appears. 2. Liquidity can disappear. Fast ETFs are liquid until they're not. In a bull market, everything seems fine. But in times of panic, like the COVID crash or 2008, ETF liquidity can dry up, spreads widen, and market makers disappear. This leads to price dislocation, where the ETF trades at a massive discount or premium compared to the net asset value. That's a hidden risk most investors completely ignore. 3. Hidden concentration. Risk. You might think your ETF is diversified, but is it really? Take a look at most S&P 500 ETFs. Over 25% of the weighting is in just a handful of tech giants like Apple, Microsoft, and Amazon. If those stocks fall, your diversified portfolio crashes too. It's not uncommon for top 5 holdings to control a huge chunk of the performance. You think you're playing it safe, but you're actually highly exposed. 4. Passive flows. Create bubbles. ETFs don't think. They don't analyze companies. They don't consider valuations. They buy whatever the index tells them to buy. This creates a feedback loop where popular stocks get bought more and more, regardless of fundamentals. This passive flow creates price distortions and, in some cases, bubbles. That's not just a theory. Many experts now warn that ETF flows are pushing valuations into unsustainable territory. 5. ETFs can kill price discovery. In a world where trillions are managed passively, who's left to do the actual analysis? Fewer and fewer investors are actually reading balance sheets or attending earnings calls. This erodes market efficiency. Over time, price discovery, the process of determining the fair value of a stock, breaks down. This can lead to mispriced assets, flash crashes, and systemic instability. 6. Too many copycat ETFs. ETFs started simple, but now there are thousands. Some are leveraged, some inverse, some thematic, and many are just marketing gimmicks. You've got ETFs for everything from vegan innovation to space travel to cannabis logistics. The problem is, many of these ETFs are thinly traded, poorly constructed, and highly volatile. If you jump in just for the hype, you could be left holding the bag. 7. Tracking error and fees still matter. Even low-cost ETFs have costs, and those costs can add up. Some ETFs don't perfectly track their index, leading to tracking error. You might think you're matching the market, but your returns could lag due to management fees, rebalancing issues, or slippage. And when you pile on synthetic exposure or exotic strategies, tracking error becomes a real concern. 8. Tax surprises. ETFs are often praised for their tax efficiency, but that's not always guaranteed. For example, bond ETFs can generate unexpected taxable events. International ETFs might be subject to foreign tax withholding. And if you sell ETFs at a gain outside of a tax-sheltered account, you're looking at capital gains taxes just like stocks. Don't assume ETFs are tax-free. 9. Systemic risk. Nobody talks about. Here's a real nightmare scenario. What happens if the ETH ecosystem freezes? If market makers stop functioning, or if the underlying assets can't be priced during a crisis, ETF trading could halt. That's not just theoretical. The SEC and BIS have raised concerns about systemic ETF risk, especially during liquidity crunches. If too much capital is parked in passive products, the system becomes fragile. 10. Emotional complacency. One of the most dangerous aspects of ETF investing is psychological. People think ETFs are safe and boring, so they stop paying attention. They don't research. They don't watch valuations. They don't adapt. That complacency leads to overconfidence. In reality, any asset, even a low-cost ETF, can drop 50% in a bear market. So what can you do? First, be selective. Not all ETFs are bad, but understand what you own. Look under the hood. Check the top holdings. Understand the index construction. Avoid niche or gimmick ETFs unless you fully understand the risk. Second, diversify across asset classes, not just across ETFs. Consider real assets, cash, crypto, or dividend stocks. True diversification means more than owning multiple ETFs. Third, stay active with your passive portfolio. Rebalance, monitor, adjust. Even if you use ETFs, don't treat your investments like a savings account. Stay sharp. Final thoughts. ETFs are powerful tools, but they're still tools. And like any tool, they can be misused. Don't fall for the myth that ETFs are completely safe or foolproof. They're complex financial products with real risks. Be smart, stay educated, and never stop asking questions. If you found this breakdown helpful, hit the like button, subscribe to CapitalSuite, and check out the free investment resources in the description. If you want even deeper research, join the premium community. We dive into stocks, crypto, and smart wealth-building strategies every single week. Thanks for watching, and remember, the best investor is an informed investor.